WeWork was valued at $47 billion and hailed as the undisputed future of commercial real estate. It was the crown jewel of the venture capital ecosystem, a company that promised to fundamentally revolutionize the way humanity interacted with physical workspace. Yet precisely 6 weeks after publishing their financial documents to go public, the chief executive officer was ousted, the initial public offering was completely abandoned, and the entire enterprise found itself teetering on the absolute brink of bankruptcy. The story of WeWork is not merely the chronicle of a failed real estate venture, it is the definitive cautionary tale of the 21st century financial era. It is a story that exposes the profound vulnerabilities of a macroeconomic environment flooded with cheap capital, the hypnotic power of charismatic founders, and the catastrophic consequences of abandoning traditional corporate governance in pursuit of relentless, unprofitable growth.
To understand how a company could evaporate tens of billions of dollars in perceived value in roughly 42 days, one must examine the fragile foundations upon which the $47 billion mirage was constructed.
The origins of WeWork trace back to 2010 in New York City, founded by Adam Neumann and Miguel McKelvey. The two entrepreneurs had previously collaborated on a shared workspace business known as Green Desk, which primarily focused on sustainable, eco-friendly office solutions. After selling their interest in Green Desk, they utilized the proceeds to launch WeWork, a venture that took the core concept of co-working and injected it with the high-octane ambition of a Silicon Valley technology startup. The underlying premise was deceptively simple but highly appealing in the wake of the 2008 financial crisis. As the modern workforce increasingly shifted toward freelancing, independent contracting, and agile startup models, there was a growing demand for flexible office space. Traditional commercial real estate required companies to sign restrictive, multi-year leases and invest heavily in their own infrastructure, furniture, and amenities. WeWork proposed a model where individuals and organizations could lower their fixed costs by converting long-term lease obligations into flexible, short-term solutions. A company could rent a single desk for a month or an entire floor for a year, with the ability to expand or contract their spatial footprint as their evolving business needs dictated. However, Neumann and McKelvey envisioned something far more profound than a mere desk rental service. They sought to cultivate a global community, tapping into a millennial generation that was increasingly demonstrating a willingness to share resources in pursuit of value, quality, and a sense of belonging. The physical spaces were meticulously designed to foster collaboration and humanize the work experience, featuring open floor plans, modern aesthetics, glass-walled offices, and extensive communal areas equipped with premium amenities like artisan coffee and, famously, fruit-infused water and beer on tap. This community-centric approach allowed WeWork to transcend the traditional boundaries of commercial real estate. By branding itself as a space-as-a-service platform, the company successfully convinced the venture capital world that it was not a property manager, but a rapidly scaling technology firm. This distinction was critical. Real estate companies are traditionally valued based on their underlying assets, cash flows, and relatively modest profit margins. Technology companies, conversely, are often valued based on their user growth, market share, and potential for future monopolistic dominance, allowing them to command astronomical valuation multiples even while operating at massive losses. The transformation of WeWork from a successful local co-working space into a $47 billion global phenomenon was primarily fueled by the unprecedented financial backing of the SoftBank Vision Fund, guided by its visionary and often controversial chairman, Masayoshi Son. SoftBank's investment philosophy during this era was defined by a belief in aggressive, hyper-accelerated scaling. The strategy dictated that startups should secure overwhelming amounts of capital to rapidly expand their geographic footprint, crush potential competitors, and capture total market dominance, worrying about profitability only after a monopoly had been established. In a now legendary encounter, Son reportedly took a brief car ride with Adam Neumann and subsequently informed the WeWork founder that his plans were simply not crazy enough. This interaction catalyzed a period of unrestrained expansion. In 2017, SoftBank injected an initial $4.4 billion into the company. Over the following years, SoftBank and its various affiliates would ultimately pour roughly $10.3 billion into the enterprise, artificially inflating its valuation round after round, completely insulating the company from the traditional financial disciplines of margin control and prudent risk management. By January 2019, SoftBank led a funding round that assigned WeWork the mythical valuation of $47 billion, making it one of the most valuable privately held startups in global history. However, beneath the towering valuation and the rapid global rollout of new office locations, the fundamental economic architecture of WeWork was exceedingly fragile, harboring a systemic risk known in financial circles as a duration mismatch. To secure the premium office space required for its global network, WeWork signed traditional, rigid commercial leases with property owners. These leases were typically long-term commitments, locking the company into fixed rental payments for periods spanning 10 to 15 years. Conversely, the revenue generated to service these massive liabilities came from the subleasees, the freelancers, small businesses, and enterprise teams who were attracted specifically to WeWork because of the flexibility of short-term, month-to-month memberships. In a robust economic environment characterized by high employment, freely flowing venture capital, and rising property demand, this arbitrage generated significant cash flow. But structurally, it positioned WeWork to bear the entirety of the macroeconomic risk. If an economic downturn were to occur, or if a global crisis were to empty office buildings, the flexible short-term tenants could simply cancel their memberships and vacate the premises with minimal notice. This would instantly sever the company's revenue streams. Meanwhile, WeWork would remain legally bound to its landlords, obligated to continue paying fixed, long-term rent on millions of square feet of entirely empty office space. As the company prepared to transition to the public markets, its internal financial data revealed an astonishing $47 billion in undiscounted long-term lease obligations, an existential financial overhang that would soon deeply alarm institutional analysts. To contextualize the immediate severity of this burden, the company's lease and other cash obligations for the single year of 2020 totaled approximately $2.3 billion.
The aggressive expansion mandated by SoftBank's capital came at an extraordinary operational cost. As WeWork prioritized raw geographic footprint over unit economics, opening hundreds of locations across the globe, its financial losses compounded at a staggering rate. The company's internal metrics revealed a net loss of $1.9 billion for the full year of 2018. As the company accelerated its preparations for an initial public offering in the first half of 2019, it managed to lose an additional $900 million in just 6 months. The quarterly burn rate was breathtaking, with operating losses routinely exceeding $1 billion per quarter. Faced with the seemingly insurmountable challenge of presenting a structurally unprofitable, capital-intensive real estate business as an attractive, high-growth technology investment, the company's leadership engaged in highly creative, non-standard financial accounting. To obscure the harsh realities of their business model, WeWork devised one of the most widely ridiculed financial metrics in modern corporate history: community-adjusted EBITDA. In traditional financial analysis, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a standard non-GAAP metric used by investors to evaluate a company's underlying operational profitability by excluding the costs associated with its capital structure, tax environment, and historical asset depreciation. WeWork's novel variation took this accepted concept to a profoundly absurd extreme. The company calculated its community-adjusted EBITDA by stripping out not only interest, taxes, and depreciation, but also what it broadly categorized as building and community-level operating expenses. Under this highly engineered definition, the company was measuring its profitability by actively ignoring the cost of rent and tenancy expenses, utilities, internet services, the salaries of building staff, and the cost of building amenities. Furthermore, the metric also excluded marketing expenses, general and administrative costs, and development and design costs. WeWork openly admitted in its filings that these building and community-level expenses represented its largest category of costs. In effect, a commercial real estate leasing company was asking public market investors to evaluate its financial performance while completely ignoring the cost of acquiring, building, staffing, and maintaining the real estate itself. By mathematically erasing its fundamental operating expenses, standard accounting losses were miraculously transformed into positive figures. For example, in the first quarter of 2019, while the company suffered massive, unadjusted operating losses of nearly $640 million, its community-adjusted EBITDA presented a positive result of $170 million against roughly $728 million in revenue.
This metric was designed to theoretically demonstrate the underlying viability of the desk renting model, provided the observer was willing to suspend disbelief and ignore the cost of the desks and the buildings that housed them. When this metric was eventually exposed to the rigorous scrutiny of public market analysts, it did not inspire confidence. Instead, it became the focal point of intense derision, instantly eroding the company's credibility and signaling to the broader market that the entire enterprise was built upon a foundation of financial obfuscation. The financial mechanics of WeWork were deeply concerning, but they were inextricably linked to a corporate culture that had been engineered by Adam Neumann to resemble a messianic movement rather than a standard corporate entity. Neumann possessed a unique, hypnotic charisma that he utilized to extract immense dedication from his workforce and secure vast sums of capital from his investors. Under his leadership, the company explicitly blurred the lines between life, labor, and spiritual fulfillment, operating with an ethos that demanded total ideological commitment from its employees. This culture was famously characterized by an intense work hard, play hard dynamic that frequently crossed the boundaries of standard corporate propriety into the realm of bacchanalial excess. The physical workspaces and corporate offices were adorned with neon signs sporting slogans such as "Hustle Harder" and "Thank God It's Monday," promoting a millennial hipster aesthetic that romanticized relentless labor. Alcohol was deeply integrated into the daily operations and executive functions of the business, particularly in the company's first half-decade. Neumann frequently expressed his belief that alcohol served as a mechanism to bring people together, and premium tequila, specifically his preferred brand, Don Julio 1942, flowed freely throughout the organization. At executive retreats, cases of the tequila, which retailed for over $110 a bottle, were heavily consumed, with pours sometimes commencing early in the morning. This environment of emotional extremes and substance-fueled camaraderie was jarringly illustrated by an incident in 2016. After instituting a round of corporate layoffs that abruptly eliminated 7% of the staff, Neumann addressed the remaining employees in a somber all-hands meeting at the company headquarters. He told the attendees that the move was tough but necessary to cut costs, and that the company would ultimately be stronger for it. However, the melancholy tone was immediately shattered when employees carrying trays of plastic shot glasses filled with tequila entered the room. The somber address instantly transitioned to toasts and drinking. Moments later, Daryl McDaniels of the legendary hip-hop group Run DMC entered the space, embraced Neumann, and began performing a musical set for the staff. Employees began dancing to the 1980s hit "It's Tricky" as the tequila trays continued to circulate, leaving many workers, who were still actively processing the sudden termination of their colleagues, thoroughly stunned, alienated, and confused by the whiplash in tone. The absolute zenith of this corporate culture was the company's annual summer camp gatherings. These events were mandatory corporate retreats where thousands of WeWork employees were flown to a central location, such as a sprawling field outside London in August 2018, for days of music, drinking, and spiritual lectures. The sheer scale of the waste and excess at these events was staggering. Employees were provided with wristbands to pick up drinks, but to avoid waiting in lines, many simply opted to grab entire bottles of rosé wine, consuming them as they stumbled around the fairground. Between sets of rave music and live bands, the intoxicated workforce was subjected to on-stage talks by spiritual figures like Deepak Chopra, interspersed with grand, sweeping speeches by Neumann himself. In one particularly memorable address, Neumann sincerely suggested to his staff that utilizing the power of their global member network, the company could pivot its focus to unilaterally solve the global crisis of orphaned children within 2 years, before subsequently moving on to eradicate world hunger. The fervor expected of employees at these events was absolute. At least one individual was reportedly terminated simply for committing the inexcusable offense of departing the mandatory summer camp festivities early. The culture had grown so extreme that observers and journalists began increasingly to question whether WeWork had devolved into some form of corporate cult. The deeply unconventional corporate culture was mirrored by an equally unconventional and deeply flawed corporate governance structure. The board of directors, which included prominent venture capitalists, lacked independence and failed entirely in its fundamental fiduciary duty to challenge or oversee the chief executive officer. They allowed Adam Neumann to operate the heavily capitalized, multi-billion-dollar enterprise with the unchecked authority of an absolute monarch, creating an environment that was fundamentally ripe for unprecedented self-dealing and conflicts of interest. The primary mechanism of this control was a heavily skewed dual-class stock structure. Neumann was granted a special class of shares that carried an astonishing 20 times the voting power of average shareholders. This disproportionate concentration of voting rights granted him near total control over the company's strategic direction, rendering the board of directors effectively powerless to remove him or overrule his directives, no matter how erratic his leadership became. Empowered by this absolute control, Neumann repeatedly treated the heavily capitalized startup as a personal treasury, engaging in practices that severely breached standard corporate ethics and alarmed corporate governance experts. He utilized the company's balance sheet to fund a lavish, high-flying lifestyle, most notably through the acquisition of a $63 million Gulfstream private jet purchased using company capital. Neumann reportedly utilized the jet extensively for international travel, with multiple sources claiming that he frequently consumed marijuana while airborne, adding further liability and erraticism to his leadership profile. Beyond frivolous expenditures, Neumann engaged in highly questionable financial arrangements with the company. He obtained millions of dollars in personal loans directly from WeWork, with interest rates set incredibly low, sometimes at just 0.64%. He further leveraged his position by taking out massive lines of credit, including a reported $500 million credit line secured by pledges of his company stock. This arrangement allowed him to extract hundreds of millions of dollars in personal liquidity based on the inflated private market valuation, while simultaneously restricting rank-and-file employees from selling their own stock. The conflicts of interest extended into the core operations of the real estate business itself. Neumann personally purchased commercial real estate properties and subsequently leased those exact buildings back to WeWork, directly profiting from the company's own lease expenditures. He was effectively acting as both the landlord and the tenant, negotiating with himself while utilizing investor capital to enrich his personal portfolio.
The most egregious and symbolic example of self-dealing, however, involved the company's intellectual property. As WeWork began preparing for its public offering, it embarked on a rebranding campaign, renaming itself the We Company to reflect its broadening ambitions, which now included side ventures like We Live residential apartments and We Grow educational facilities. In a transaction that would later become infamous, Neumann quietly trademarked the word "we" through a private entity he controlled, known as WE Holdings LLC. He then orchestrated a deal to sell the licensing rights for the We trademark back to his own company for approximately $5.9 million. While $5.9 million was a nominal sum compared to the company's multi-billion-dollar operational cash burn, the transaction served as a powerful symbolic representation of the founder's hubris and the board's utter failure to protect investor interests. The governance issues even extended beyond financial self-dealing into the realm of dynastic succession planning. As part of the transition to a public company, the board of directors established a contingency plan in the event of Adam Neumann's death or permanent disability during the 10-year period following the initial public offering. Rather than tasking the board of directors with conducting a standard executive search, the protocol dictated the formation of a special committee whose sole purpose was to select a new chief executive. The composition of this committee was heavily weighted to ensure that Neumann's wife and co-founder, Rebecca Neumann, retained ultimate control over the company's fate. The committee was to consist of Rebecca Neumann alongside two existing board members, Bruce Dunleavy and Stephen Langman. However, the terms explicitly stated that if neither Dunleavy nor Langman were serving on the board at the time, Rebecca would have the sole authority to choose one or two other board members to serve alongside her.
Crucially, any selection of a new chief executive officer required the unanimous approval of this committee. This extraordinary arrangement effectively granted the CEO's spouse an absolute veto over the future leadership of a publicly traded corporation, a dynamic virtually unheard of in modern corporate governance. Furthermore, if Rebecca Neumann were unable to serve, a trustee acting on behalf of the couple's estate would assume this sweeping authority, ensuring that control of the multi-billion-dollar enterprise remained strictly within the Neumann family. For nearly a decade, the private markets had sustained the illusion of WeWork's superiority. The opacity afforded to privately held companies allowed leadership to tightly control the narrative, emphasizing top-line revenue growth and geographic expansion while masking the catastrophic cash burn, the mounting lease liabilities, and the deeply compromised government structures. However, the transition from a private unicorn to a publicly traded corporation requires radical transparency, mandated by federal securities laws. The turning point from private market darling to public market pariah occurred precisely on August 14, 2019, when WeWork formally filed its S-1 registration statement with the Securities and Exchange Commission. The S-1 is the foundational document of any initial public offering, designed to provide prospective investors with an exhaustive, audited view of a company's historical financial performance, operational metrics, internal structures, and potential risk factors. The publication of the WeWork S-1 forcibly shattered the carefully cultivated corporate opacity, exposing the internal mechanics of the company to the relentless, unsentimental discipline of public market scrutiny. The document itself was a masterpiece of corporate hubris, reading more like a spiritual manifesto than a financial prospectus. It opened with a dedication page that boldly proclaimed, "We dedicate this to the energy of we, greater than any one of us, but inside each of us." The document proceeded to explicitly name and thank specific employees, creative team members, and prominent clients, including Chief Architect Bjarke Ingels and community members like Olivia Thompson, Molly McArdle, and Jay Deere. This eccentric formatting was immediately followed by a mission statement that cemented the company's detachment from the realities of commercial real estate. The second line of the S-1 declared, with profound earnestness, that the company's ultimate mission was to elevate the world's consciousness. To the financial analysts and institutional investors reading the document, the juxtaposition of this grandiose, messianic language against the grim reality of a structurally unprofitable desk rental business was deeply alarming. Within 48 hours of the document's publication, the financial press unleashed a barrage of deeply critical analyses. Leading publications, including The Wall Street Journal, The Financial Times, Bloomberg, and The Atlantic, published extensive breakdowns of the company's economics and governance structures. The media and public market analysts aggressively pored over the numbers that had previously been hidden from view. They highlighted the $1.9 billion net loss from 2018, the bizarre and misleading implementation of community-adjusted EBITDA, the staggering $47 billion in undiscounted future lease commitments, and the myriad blatant conflicts of interest surrounding Adam and Rebecca Neumann. The impact on the company's perceived value was immediate and devastating. Institutional investors, the mutual funds, pension funds, and asset managers whose capital was required to absorb the newly issued public shares, collectively recoiled. Portfolio managers explicitly refused to engage with the offering at anywhere near the private market valuation of $47 billion. They recognized that despite the rapid revenue growth and the appealing physical aesthetics of the office spaces, a heavily indebted real estate leasing company with no clear path to profitability and a profoundly entrenched, conflicted chief executive was fundamentally uninvestable at a technology valuation multiple. The period immediately following the August 14th publication of the S-1 was characterized by rapidly escalating panic within the company's executive ranks, its board of directors, and its primary underwriters. The underwriters managing the public offering, primarily J.P. Morgan Chase and Goldman Sachs, quickly recognized the complete lack of market appetite. They reportedly began pressuring WeWork's leadership to drastically amend the corporate governance structures and significantly lower the target valuation before attempting to launch a formal investor roadshow to market the stock. As the weeks progressed through late August and into early September, the marketed valuation range began to slip rapidly in the financial press, plummeting from the initial $47 billion down towards $20 to $25 billion, representing a halving of the company's theoretical worth in a matter of days. In a desperate attempt to salvage the offering and quell the institutional unrest, the company initiated a series of rapid concessions. On September 4, 2019, bowing to immense public pressure and outrage over the blatant self-dealing, Adam Neumann directed the unwinding of the highly controversial $5.9 million trademark transaction, formally returning the rights to the We family of trademarks to the company. However, this nominal concession was vastly insufficient. The core issues, the systemic unprofitability, the duration mismatch of the leases, and Neumann's overwhelming 20 times voting control remained entirely unresolved. Recognizing that proceeding with the investor roadshow under these conditions would result in a humiliating failure to raise any capital, the company formally postponed the initial public offering on September 17, 2019. This postponement triggered an immediate, fatal liquidity crisis. WeWork was burning through its cash reserves at a catastrophic rate, sustaining its massive global operations and lease payments solely on the expectation of fresh capital. It had been relying on the proceeds of the impending public offering, along with an associated multi-billion-dollar debt facility that was strictly contingent on a successful public listing, to fund its ongoing survival. With the offering delayed indefinitely, the company was suddenly facing the imminent prospect of running completely out of capital and defaulting on its obligations. The focus of the crisis then shifted aggressively to the boardroom, specifically targeting the continued leadership of Adam Neumann. SoftBank, serving as the largest external investor and the primary architect of the inflated $47 billion valuation, recognized that Neumann's continued presence as chief executive was an insurmountable barrier to raising external capital, restoring market confidence, or stabilizing the firm. Over the weekend of September 22 through September 24, high-stakes negotiations and emergency board meetings took place, with SoftBank and other key investors actively exploring mechanisms to replace the founder. The situation was intensely complicated by Neumann's super voting shares, which theoretically allowed him to override any board decision and resist his own termination. However, the dire financial reality forced his hand. The company would soon default on its lease obligations and plunge into bankruptcy without an immediate, massive capital injection, and investors absolutely refused to provide that capital while he remained in charge. On September 24, 2019, exactly 6 weeks after the publication of the S1, Adam Neumann formally stepped down as the chief executive officer of WeWork. While he initially retained a non-executive chairman of the board, his era of absolute control had ended. With the visionary architect of the company's aggressive expansion removed, the remaining interim leadership completely abandoned the public offering efforts. On September 30, 2019, the company formally submitted documentation to the Securities and Exchange Commission to withdraw the S1 registration statement. The $47 billion mirage had fully dissipated. In the span of 6 weeks, the marketed valuation had collapsed to below $10 billion. The institutional buyer base had publicly rejected the enterprise, and the company was left fighting for basic survival.
By October 2019, WeWork was mere weeks away from total insolvency. The withdrawal of the initial public offering left the company completely devoid of the capital necessary to service its immense commercial lease obligations and sustain its thousands of global employees. With no viable alternatives in the private or public markets, the board was forced to turn back to SoftBank to orchestrate an emergency rescue. On October 22 and 23, 2019, SoftBank and WeWork announced a comprehensive multi-billion-dollar bailout package. The financing package was massive in scale, including $5 billion in new debt financing, the acceleration of an existing $1.5 billion funding commitment, and the launch of a tender offer of up to $3 billion to buy out existing shareholders. SoftBank's intervention fundamentally recapitalized the failing company, but it came at a severe, punitive cost to the existing equity holders. The rescue package officially valued the entirety of WeWork at under $8 billion.
This represented a staggering 83% discount from the $47 billion valuation championed just 9 months prior, effectively vaporizing tens of billions of dollars in paper wealth. As a result of the equity dilution and the massive tender offer, SoftBank took control of approximately 80% of the company's fully diluted economic ownership. However, carefully managing its own balance sheet exposure, SoftBank structured the transaction specifically to avoid holding a majority of voting rights at board meetings, thereby preventing WeWork from being consolidated as a direct subsidiary. Concurrently, SoftBank executive Marcelo Clauer was appointed as the executive chairman of the board to oversee the grueling turnaround efforts. The most controversial and widely criticized element of the bailout, however, was the staggering exit package negotiated for the ousted founder. In exchange for relinquishing his super voting rights, stepping down from the board entirely, and clearing the path for SoftBank's complete takeover, Adam Neumann was granted a golden parachute initially estimated at $1.7 billion. This extraordinary compensation package included hundreds of millions of dollars in cash, the ability to sell a massive tranche of his personal stock in the tender offer, and the refinancing of his personal debts on highly favorable terms. Although this package was later renegotiated following intense public backlash and legal disputes between Neumann and SoftBank, ultimately resulting in a settlement where Neumann received approximately $445 million, comprised of a $245 million stock grant, $200 million in cash, and the refinancing of $432 million of debt. The sheer scale of the payout generated widespread outrage. To the broader public and the corporate governance community, it appeared that the architect of one of the greatest corporate destructions in history was being richly rewarded for his failure. The opulence of the founder's exit stood in jarring, painful contrast to the immediate fate of the company's workforce. To stem the massive operational cash burn and satisfy SoftBank's demands for structural efficiency, the newly installed management team initiated a brutal restructuring program. On November 21, 2019, less than a month after the SoftBank bailout was finalized, WeWork announced the termination of approximately 2,400 employees, representing nearly 20% of its entire global workforce.
The employees who had bought into the community ethos, attending the mandatory summer camps and working long hours under the promise of changing the world, were abruptly dismissed just weeks before the holidays. The side ventures that had justified the sprawling We Company moniker, such as the We Live residential apartments and the We Grow educational initiatives, were swiftly shuttered or sold off. The corporate name was quietly reverted to simply WeWork. The culture of boundless expansion, tequila-fueled all-hands meetings, and spiritual grandiosity was immediately and permanently replaced by the grim realities of aggressive cost-cutting, desperate lease renegotiation, and institutional survival. The years following the 2019 collapse were defined by a relentless, agonizing struggle to correct the fundamental mismatch at the core of the business model. In February 2020, real estate industry veteran Sandeep Mathrani was appointed as the new chief executive officer, tasked with bringing traditional operational discipline and real estate expertise to the chaotic enterprise. Mathrani embarked on a painstaking process of analyzing the global portfolio, seeking to exit highly unprofitable leases, renegotiate terms with landlords, and eliminate the excessive corporate overhead accumulated during the Neumann era. However, this rational restructuring effort was almost immediately derailed by an unforeseen macroeconomic shock of historic proportions: the global COVID-19 pandemic. By March 2020, the exact vulnerability inherent in WeWork's duration mismatch was violently exposed on a global scale. As governments mandated lockdowns and corporations shifted entirely to remote work, commercial office demand plummeted to historic lows. WeWork's flexible members, who were only bound by short-term contracts, were able to cancel their memberships with ease. This left the company with plunging revenues while still remaining legally obligated to pay rent on its vast, empty real estate portfolio. Offices closed globally, and the company was forced to issue dire warnings of extreme uncertainty regarding its future viability. Despite these existential headwinds and the ongoing cash burn,
The company leveraged the highly speculative fervor of the 2021 financial markets to finally achieve its long-delayed public listing. On March 26, 2021, WeWork announced an agreement to merge with BowX Acquisition Corp., a special-purpose acquisition company, a SPAC. A SPAC is essentially a shell corporation listed on a stock exchange with the purpose of acquiring a private company, thereby taking it public without navigating the traditional, rigorous IPO process that had destroyed WeWork in 2019.
The transaction, which officially closed in October 2021, provided WeWork with approximately $1.3 billion in desperately needed cash, supported by an $800 million private investment from prominent entities including Insight Partners, Starwood Capital Group, and funds managed by BlackRock. The company finally began trading on the New York Stock Exchange under the ticker symbol WE. However, the valuation assigned during this SPAC merger was approximately $9 billion. While substantial, this figure was a mere fraction of its 2019 peak, reflecting the deep, lingering skepticism that continued to surround the viability of the co-working business model in a post-pandemic world. The massive infusion of capital from the SPAC merger ultimately served only to delay the inevitable reckoning. The structural insolvency of the lease portfolio, heavily exacerbated by the permanent macroeconomic shift in commercial real estate demand caused by the normalization of remote and hybrid work models, proved too massive for Masquerade or his successors to overcome. The company continued to generate substantial operational losses year after year, slowly burning through the newly acquired liquidity as it struggled to service over $4 billion in accumulated debt. By late 2023, the financial mathematics had become completely untenable. On November 6, 2023, just over 2 years after finally going public via the SPAC merger, WeWork and hundreds of its direct and indirect affiliates officially filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the District of New Jersey. The Chapter 11 filing was a stark admission of defeat. At the time of the filing, the company's common stock had declined by more than 98% for the year, effectively wiping out retail investors, and it reported holding over $4.2 billion in outstanding debt obligations, the vast majority of which were secured by the company's dwindling assets. The bankruptcy process, guided by elite restructuring advisors from firms like Davis Polk and Weil, allowed WeWork to legally utilize the power of the federal courts to shed roughly $4 billion in debt. Crucially, the Chapter 11 framework allowed the company to aggressively renegotiate or outright reject hundreds of unprofitable commercial leases, forcing landlords to absorb massive losses to right-size the company's geographic footprint.
The complex restructuring plan, which received unanimous support from the voting pre-petition lenders and secured note holders, was centered on a drastic financial reorganization. The plan dictated the complete equitization of the company's secured debt and the total cancellation of all pre-existing equity interests. In practical terms, this meant that the shareholders who had held stock prior to the bankruptcy were entirely wiped out, receiving nothing, while the secured creditors exchanged their massive debt holdings for direct ownership stakes in the newly reorganized entity. On May 30, 2024, the bankruptcy court officially entered an order confirming the restructuring plan, and WeWork formally emerged from Chapter 11 protection shortly after, on June 11, 2024. The newly reorganized company emerged from the legal proceedings as a private entity with a significantly reduced geographic footprint, operating roughly 337 locations in the United States and Canada, and a fundamentally altered ownership structure. Cooper Grimmond, an affiliate of the real estate software firm Yardi Systems, emerged from the bankruptcy as the new majority owner with a 60% stake in the enterprise. SoftBank, the primary enabler of the company's hyper-growth era, saw its holdings reduced to a minority 20% share, finalizing one of the most catastrophic losses of venture capital in modern corporate history. The 6-week collapse of WeWork in the late summer of 2019, culminating in its eventual bankruptcy and fundamental restructuring, stands as a defining epoch in modern corporate finance.
The saga serves as the ultimate doctrinal reference point for the limits of the venture capital ecosystem, vividly illustrating exactly what occurs when the unchecked pursuit of hypergrowth collides with the unforgiving realities of public market discipline, transparency, and fundamental unit economics. The spectacular failure of WeWork was not merely the result of a single eccentric founder or a momentary lapse in strategic judgment. The collapse was profoundly systemic, driven by a macroeconomic environment overflowing with cheap capital desperately seeking yield, and a broader cultural shift that had dangerously elevated technology founders to the status of infallible visionaries. The complete lack of independent board oversight, the blatant abdication of fiduciary duty, and the willingness of sophisticated institutional investors to accept and propagate inherently nonsensical financial metrics like community-adjusted EBITDA demonstrate how collective financial mania can entirely distort rational market pricing. Furthermore, the saga highlights the fundamental existential danger of actively mischaracterizing a business model simply to achieve favorable valuation multiples. WeWork was, at its core, a highly leveraged commercial real estate subleasing operation, a traditional, highly cyclical, and intensely capital-heavy business. By draping itself in the aesthetics of a Silicon Valley software platform and adopting a messianic mission statement dedicated to elevating global consciousness, it managed to temporarily bypass the traditional risk assessments strictly applied to property management firms. When the S-1 prospectus finally forced the company to reconcile its inflated technology company valuation with its disastrous real estate balance sheet, the resulting implosion was an act of mathematical inevitability. Ultimately, the WeWork mirage forced a profound and necessary recalibration across the global startup ecosystem. It triggered deep, enduring skepticism regarding dual-class voting structures that entrench founder control, prompted rigorous regulatory and investor scrutiny of non-GAAP profitability metrics, and served as a stark, multi-billion-dollar reminder of the realities of business. While charismatic leadership, a beautifully designed product, and an inspiring corporate culture can successfully raise billions of dollars in the opaque private markets, they cannot forever suspend the fundamental laws of economics. The tumultuous journey from a $47 billion valuation to Chapter 11 bankruptcy serves as a permanent, undeniable testament to the absolute necessity of sound corporate governance, the profound danger of unchecked executive power, and the inescapable requirement that an enterprise must eventually be capable of generating actual, sustainable profit.